So, the global economy right now, in 2026, it's a complete paradox, seriously. On one side, you've got forecasts for a huge stock market rally. And on the other, a really significant chance of a global recession. How can both of those things be true at the same time? Let's break it all down.
First, let's look at the good news. You've got major players, places like Goldman Sachs, calling for strong double-digit returns for global stocks. The optimism is, well, it's pretty high. But then you have this. At the exact same time, JP Morgan's own research is flagging a 1 in 3 chance, a 35% probability, of a worldwide recession. That is a massive risk you just can't ignore.
So, what is going on here? How can we be staring down a bull run and a recession at the same time? In this explainer, we're going to dig into the two gigantic, opposing forces that are defining our world today.
Okay, so let's start with the bull case. The primary driver behind all this optimism really just boils down to 2 letters: AI, artificial intelligence.
Top analysts are using this term, an AI supercycle. And what they mean is a long, sustained period of super high growth, all driven by AI. And this isn't just some tech bubble thing. It's a tidal wave of investment and profit growth that's now spreading across the entire economy.
And listen, this isn't just talk. The numbers are actually backing it up. JP Morgan is predicting S&P 500 earnings will grow by 13 to 15%. That's way above the average. At the same time, Goldman and the IMF are seeing global GDP holding surprisingly strong. And this slide really shows you how that boom is spreading out. You know, it all started with the enablers, the companies making the chips and the software. But now it's moving to the adopters. We're talking industries like banking, healthcare, even utilities that are using AI to get better. And that is fueling a massive build-out of infrastructure, everything from data centers to entire power grids. But here's the thing, this incredibly optimistic picture, this whole tech-driven boom, it's only half of the story. Because while the digital world seems to be soaring, the physical world, well, it's fracturing.
Geopolitical analysts over at Control Risks are warning that global tensions are so incredibly high right now that the line for starting a conflict is getting lower and lower. The world has basically become a tinderbox, where even a small accident could spark a massive crisis.
And this isn't some hypothetical. We're seeing it happen in real time. The conflict in the Middle East has pretty much shut down the Strait of Hormuz, which is without a doubt the single most critical choke point for all of global trade.
So, why is that one little strait such a big deal? Well, just look at this. A staggering 35% of the world's exported urea, and that's a key ingredient in fertilizer, goes right through there, a third of the world's supply. And the results? It was immediate and it was harsh. Global urea prices just shot up by 26% almost overnight. And look, that's not just some abstract number on a chart. That's a direct threat to global food production, to food security. You know, breaking down these complex links between something happening halfway around the world and what it means for you, that's exactly what we do here every week. So if you want to understand the forces really shaping our world, make sure you subscribe. Of course, the shockwaves from that closure ripped through financial markets almost instantly. Germany's DAX index fell 10% in just 1 month. Major indexes in the US and Japan also took huge hits, basically erasing a lot of that optimism we saw at the start of the year. So this brings us back to that central question. How can a booming tech market and a fracturing, chaotic world exist at the very same time? Well, the answer isn't a simple bull market or bear market. The key concept here is what JP Morgan calls multidimensional polarization. Basically, the economy is splitting into 2 different tracks, the winners and the losers. You see it with AI companies thriving while others get left behind, or with corporations making record profits while the job market feels weak. The absolute best way to picture this is as a K-shaped economy. You have one arm of the K soaring upwards. That's the tech-driven, resilient part of the economy. But then you have the other arm sloping downwards, and that represents all the sectors and all the households getting left behind by these huge shifts. And maybe the biggest risk in this new environment is actually psychological. Control Risks has a name for it, the normalization trap. It's the danger of just getting so used to chaos and crisis that we stop paying attention, and we fail to see the next big shock when it's right around the corner. So what's the bottom line here? What do you really need to take away? It's that our world in 2026 isn't just one thing. It's both risky and resilient at the same time.
That AI boom is acting like a huge cushion against all this global instability. But the real danger is us, becoming complacent.
Now, in this polarized, K-shaped world, there are going to be very clear winners and very clear losers. If you want to know which industries are set up to win, you need to click right here and watch our next explainer on the AI Supercycle. We break down exactly where the opportunities are